St. John's welding machine is 15 years old. It's fully depreciated, has no salvage value. The new welder is going to cost $182,500 and has an estimated life of 8 years. That's the useful life. After that, it's going to have no salvage value. The new welder will be much more efficient and will increase earnings before depreciation from $27,000 to $74,000 per year. The new machine will depreciate over a 5-year accelerated depreciation with 20% depreciation in the first year, 32% in the second, 19.2% in the third, 11.52% in the fourth and the fifth, and 5.76% depreciation in the final period. Firm's corporate tax rate is 40% and the cost of capital is 12%. So should the welder be replaced? So there's two different ways to approach this question and get the correct answer. The first one is probably more intuitive, so that's what we're going to do first. So what I have here is this method is we're looking at the cash flow that the firm would receive from the new machine, back out depreciation, then identify the tax after depreciation has been taken out. Then we're going to identify the after-tax earnings. We're going to add depreciation back in. So the savings difference is going to be that tax rate. Because remember the tax shield of depreciation, getting the pre-tax funds. And then we're going to back out the revenues from the old machine, but we're going to use post-tax dollars to get the difference. So the depreciation is going to be equal to the investment times the depreciation for each period and so now we're identifying our taxable income. So once we've taken out depreciation, we can see how much income is subject to a tax payment. Next, we'll recognize the tax as a cash outflow, and we'll multiply that by the amount that's subject to tax to identify the total tax liability per period. So we'll subtract tax from our taxable income, and we have our after-tax earnings. Next, we're going to add back in the depreciation. Next, what we have to do is back out for the old machine, but notice now we're dealing with after-tax dollars, so we want to not subtract $27,000, but we want to subtract the amount that we'd have after taking out taxes of the $27,000. So the old machine, again, we're going to be differencing this. We can identify it this way, where we have the old machine at $27,000 times the remainder after tax. So now we're going to difference this amount. And so this is the amount that we're receiving above the old machine. So again, these are the revenues, or we should say the cash flows, greater than the old machine. Because remember, we're benefiting from the depreciation. Next, we'll just use an NPV function to identify the value of this difference in cash flows relative to the investment at time 0. So we can see that this new machine will actually add value of 11,468.48. So we'd want to replace the welder. The other way that we can attack this problem, which is a little bit more direct, there's less steps involved, is to take the difference of the cash flows. So what you see here is the new machine less the old machine, and the difference between the two is 47,000. Next, what we'll do is back out tax. So now we'll identify our after-tax earnings. But what we're going to do now is add in the gain depreciation. So notice over here we subtracted depreciation and added it back in. But the difference was the savings here from the tax. We didn't pay 40% tax on our depreciation, that's the tax shield. So what we'll do here is recognize that. So the way to get that depreciation amount is to multiply the cost of the machine times the depreciation times the corporate tax rate. So since we now have the tax shield of depreciation, we can add that to the after-tax earnings. And so now we can see that our difference values over here match the difference values here. So all we really need to do is an NPV to confirm. And so again, we find net present value of 11,468.48. So the difference here was we worked on the left hand side, we worked cash flows as you would think they flow through the organization, where there's the earning or the income, the revenues. We take out depreciation and then take out taxes. We add back, we identify our after-tax earnings, we add back the depreciation, so we're actually looking at operating cash flows, and we compare that with what the funds that would have been received from the old machine after tax, and we identify difference. Over on the right hand side, we're saying, well, there's a difference of cash flows, we'll back out tax, and then the amount of the tax shield from depreciation, we're going to add that to the difference in after-tax earnings to find how much more money we would receive every year with the new machine, and then do an NPV relative to the cost of the equipment. Both approaches are correct, just a slightly stylized different approach.